This is Cashology by FMBO, a podcast devoted to the art and science of managing your money. It's like school, but your only homework is living your best financial life. Class is now in session.
You're throwing your money away. Do we have your attention? Okay, well, good, because you are if you haven't considered refinancing your mortgage. Welcome and thanks for listening today to Cashology Podcast. I'm your host, the resident cashologist, Juli. Today we have a very special guest to tell us about refinancing your mortgage, and his name is Brad Dombrosky. Brad has been with FMBO for over 6 years, and when he's not working as a mortgage loan originator, you can find him being a dad to 4 kids and watching football. See, bankers, they're just like us. Before we dive into the episode, don't forget to subscribe to the Cashology Podcast to get alerted about future episodes. Welcome, Brad.
Good afternoon. How are you?
Doing great. Excited to learn more about refinancing a mortgage.
Happy to help.
Well, okay. Are we ready to do the refinance dance?
Sounds good to me.
Well, let's start from the top. Can you tell us, Brad, what exactly is refinancing?
Absolutely. So essentially, a refinance is restructuring your mortgage debt to a different term or a different interest rate. So when it comes to mortgages, you can get a mortgage for 10 years, 15 years, 20 years, or 30 years. And when you get your loan, there's an interest rate that is typically locked for that duration of time. When interest rates get lower, as we are currently experiencing, the advantage to refinancing is you lower the interest rate you're paying on your mortgage. And so a lot of folks will like to lower their payments or maybe shorten their term with a lower interest rate to pay the loan off faster. There's also what's called a cash out refinance, where somebody is looking to pull equity out of their home to do home improvements or other personal items, and they pull cash out through a refinance as well.
Interesting. So what would make someone refinance? What would be some reasons why?
Well, right now in the low rate environment that we're experiencing, majority of clients are refinancing to save interest on the mortgage. So if you do an amortization schedule, the amount of mortgage interest that you pay over the life of the loan is substantial. And so anytime you can lower your interest rate and reduce that amount of interest you're paying over the life of the loan, it's kind of a no-brainer. You're saving a ton of interest. In some cases, if you're able to afford a slightly higher payment, you can reduce your term and pay your mortgage off much faster than you're currently on track for by lowering that interest rate. I also do get calls from time to time of folks that are going through some family changes. Maybe they're getting divorced and they need to buy out their soon-to-be ex-spouse with equity of the home. People will call to do improvements to the house, and they like to pull cash out of their equity to do those improvements. Or maybe there's some debt consolidation out there that the homeowner is trying to pay off some revolving debt or car loans or even student loans and include that into your mortgage.
How does it work if your home is worth more than you owe?
Well, that is what's called equity. So when it comes to a homeowner, you have the value of your home and you have the debt against your home, which is typically the mortgage. And the difference between what the value of your home is and what you owe on your mortgage is the equity that you have in the house. Now, some folks might think, well, Zillow says my house is worth this much, or I got an assessor note card that said my value is this. All of those are great. They're really not totally accurate. When a refinance happens, an appraiser will actually come out to the home, look at activity going on in the neighborhood to really figure out what your house is worth at this time.
Is there a cost associated with that? And what other considerations are there when it comes to refinancing?
Great question. So yes, there are costs when it goes to refinancing. What you have to remember is a refinance is a completely brand new mortgage. So the loan is being completely underwritten again under a new circumstance. So even if you bought your house 2 years ago or 10 years ago, your credit profile has most likely changed. Your income has maybe changed. The underwriting guidelines may have changed. So the loan has to be completely re-underwritten. There's costs involved with that. You have to close on that loan through a title company that will do a lien search against your property to make sure that there's no other liens that maybe someone's not aware of, whether it's you or the lender, because It's important when you're doing a refinance that the new mortgage is in first position as far as liens against the home. And yes, if an appraisal is done, there are costs. So the nice thing about refinancing is that I would say close to 99%, if not more, of the clients do not pay any of those refinance costs out of pocket. They do have the option to do so, but most folks, because money is so cheap, elect to have those costs rolled into the new loan because they're usually saving money on the monthly payment or they're paying the loan off faster anyway. So by having a slightly higher loan amount in the short term and not having to incur any out-of-pocket expense to do the refinance, most clients do go that route.
So when you have a mortgage with a certain bank, can you switch to a different bank for your refinancing?
About 10 years ago or so, there was loans that had what they were called prepayment penalties. And so essentially what that meant was is if you got a mortgage and had a 3-year prepayment penalty, that lender would penalize you for paying your loan off quicker. The government stepped in probably within those last 10 years and has, for the most part, gotten rid of all prepayment penalties. So if you are listening to this podcast and you have a mortgage with any bank out there, whether it's a bank or a broker or really anybody, you could take a new loan or refinance with any new lender you choose. And so, yes, you're welcome to work with anyone you want. It doesn't matter who your current loan is with.
So I love being a customer of First National. I want to know if I were to refinance my home through First National, what would I expect?
Great question. Well, every loan officer runs their business a little bit differently, but first you should expect very competitive interest rates, very competitive costs affiliated with that. You should experience great top-notch customer service. And then the most important piece is at First National Bank, we service all of our loans. Now that's a rarity in the mortgage business. What that means is after that loan closes, your loan is not being sold off to another bank and then maybe another bank in 6 months. Your loan actually stays on our books so that if you as the homeowner have a question anytime in the future, insurance changes, property tax changes, maybe you had a hail damage, really any mortgage related questions, you are calling directly back to First National or the loan officers that you worked with to answer those questions and to just answer the questions and move on with your day. High level, those are some nice benefits that what people can expect.
How important is it to find a loan officer that you get along with? I mean, how much face-to-face or interaction do I have with my loan officer?
These days, really not a lot of face-to-face interaction because of the COVID world that we're living in as we record this with social distancing. A lot of clients are busy in their lives. They have jobs or they're working remotely or they have their children. And so they like the idea that they are not required to meet face-to-face to do a refinance. Now, don't get me wrong. If someone's listening to this podcast and they would prefer to meet face-to-face, we always make those accommodations, but it is not required. And so we try to make it as convenient as possible. Typically, we'll start gathering information. If your loan's already with us, we'll recap what you already had to make sure what has changed and really just to make the experience as smooth as possible. You mentioned in the beginning, should you like the loan officer that you're working with? Here's the thing. Your mortgage is most likely the largest financial debt that any homeowner is ever going to have, really any of us. And so I've been doing this for close to 20 years. And what I've learned over the years is there's a lot of emotion when you're dealing with your mortgage. More emotions when you're buying a house than when you're refinancing. But you should work with someone that's going to communicate with you very well along the way so that you're not wondering what's going on. Is there a problem? I've had no news. And you should ask those questions to the loan officer in the beginning of the process to set that expectation of what you should experience for the refinance process.
Yeah, this is a big deal. So for someone that may not have refinanced before, I mean, what's the very first step in scoping out which bank you want to go with? And even if finding out if refinancing is for you?
Sure. So first off, I would say I'm always a fan of starting where you bank. So if you have a checking or savings account at said bank, you should check there to see if maybe they provide mortgages and then ask, will they then service that loan to make sure it stays there? If you have an existing mortgage with a certain bank, it's not a terrible idea to go back to that bank and ask, do they offer refinancing? It's also not a terrible idea to check around for at least a second opinion. A lot of my business personally started at a different bank. They were encouraged to give us a call, and in most cases, our deal was better, and they decided to work with us instead. So really start where you maybe already have an existing relationship. And then if you'd like, check with one more place just to get a second opinion to make sure that you're comfortable with what you're being offered and the person that you might be working with.
You had mentioned earlier that your credit score could have changed throughout the course of time with your mortgage. How would I know about my credit score, and if it's higher or lower, what would you recommend for customers?
So these days, a lot of our credit cards that we offer, not just with First National, but really out there, does give you a credit score every so often, whether it's on your credit card statement. There's a lot of third-party apps out there. There's Credit Karma and a lot of other website, I think Credit Nerd or something like that, where you can keep an eye on your credit. Here's the important thing that I tell all of my clients. Every credit repository that's free has their own algorithm of how they determine what your scores are. So if you got your credit card statement from, let's say, First National Bank, and it said your credit score was a 740, that doesn't necessarily mean you're going to have a 740 when we pull your credit. In the mortgage business, again, going back to it being your largest financial asset and probably your largest debt that you'll ever have, the credit that we pull is a little bit more in depth. We look at a 7-year snapshot. We're looking at anything bad that may have occurred and good, obviously. And so a lot of times those other free credit reporting things that I mentioned earlier, they're usually looking at a smaller snapshot. So you can also go to annualcreditreport.gov to get a free credit report once a year, and there's no credit inquiry to do that. So I do encourage everyone to always check their credit report at least once a year to make sure there's no fraudulent activity and that you're aware of what's going on out there.
Is there any consideration if I'm thinking about moving to a different home, whether or not refinancing is for me? Do I wait until I establish if I want to move? Or is there a time period I should consider?
And that is the very first question I ask every client that calls me that heard rates were lower and wants to refinance. Because here's the deal. When you refinance, you are in most cases resetting the amortization clock. And for those of the folks that are listening to this that are not aware, most mortgage amortizations are very heavy on the interest for those first 5 or 10 years on a 30-year. So when I ask someone if they're moving, the question I ask is, do they have any thoughts on moving in the next 3 to 5 years? The reality is if somebody's moving in 3 years, unless their interest rate is sky high, they're usually not a benefit to refinance right now because the cost that you're going to have roll back into your loan, those first 3 years isn't really giving the loan enough momentum to really get that new amortization brewing at the lower rate. And there's a chance that if you move too quickly, your loan may not be that much lower than it would have been. So great question. And yes, moving should play a very large role in if refinancing is right for you.
I didn't really consider that. And now I'm wondering, it's nice it's not right for everyone to refinance their home, especially if they're moving soon.
It's not.
What other tips or tricks or potential discounts should we look out for when we refinance a mortgage?
Great question. So again, going back to the trickiness of a mortgage amortization, and this is just how the industry works. Every time I run an analysis for any of my clients that are thinking about refinancing, let's say somebody did a 30-year note 3 years ago and they have 27 years remaining. They're not looking to increase their payment, but they are looking to save some money. I will strongly encourage and do an analysis to show that individual what it would look like if they maintain the exact same payment that they're currently making at the lower rate. When you make more than the minimum on a mortgage, the amortization is skewed more than you'd ever imagine. And so sometimes someone might be saving, let's call it $100 a month. They've been in their loan for 3 years. They refinance to a lower interest rate. By maintaining that same payment they were already making, they might shave another 3, 4, 5 plus years. And what I tell folks is this isn't affecting your cash flow. This is keeping the same payment going and now saving you more money. Mind you, some people do want to save that cash flow, and that's totally okay. At the end of the day, it's just about educating consumers on what's the best for them and what's making them hopefully the biggest savings. As far as lowering your term, let's face it, nobody wants to have a mortgage. There's a big attractive to say, I want a 15-year fix because the rate is lower on a shorter term note, but those payments could be much higher than you're comfortable paying. So another piece to the puzzle is to not chase a payment that you may regret later. All loans in today's environment, as I mentioned earlier, have no prepayment penalties. So there's nothing wrong with taking a 30-year note or a 20-year note and paying that off in 15 years and having some cash flow flexibility if you need that money every once in a while to go on a vacation or to fix some things up in the home. Whereas if you went aggressive right off the bat to, let's say, a 15-year fix, you may have a payment more than you're really comfortable with for the next 15 years of your life. So again, it's just about making sure you're being educated on your choices. At the end of the day, the lowest interest rate isn't always the best deal because sometimes a lender will offer you the lowest rate and charge you additional costs to get it. So it's really just about being educated, asking some of the questions that we've been talking about today, or looking through your budget to figure out what payment you can afford and how long you think you might be in the home to see if a refinance does make sense for you in this low rate environment.
A great set of tips. I mean, ultimately what we care about is the financial health of our customers. And if refinancing is right for you, a loan officer at FMBO will certainly help. The one little tidbit I wanted to share is, did you know this, Brad, that in Scotland, people paint the front of their door red when their mortgage is paid off?
That's a beautiful thing.
Did you know that?
I was not aware. I'd love to see a lot of red doors in our...
Yeah, we want to see a lot of red doors. Well, Brad, if a customer wants to get in contact with you about refinancing their mortgage, how would they do that?
So first, I am located at the First National Bank branch at 132nd and Center. The best way to reach me is typically through my cell phone, which is 402-512-0041. My website is a great place to get some more information and to fill out information if somebody wanted to look what a refinance looks like. And that is my name, BradDombrosky.com.
Awesome. Brad, you've been a great guest. Thank you so much for sharing all of your knowledge with us.
Thank you for the time. Have a great day.
Yeah, thanks everyone for listening. Don't forget to subscribe and keep an eye out for future episodes of the Cashology Podcast coming soon.